This is going to completely change the dynamics that have existed for investors over the last decade. Pretty much everything that worked while the Fed was inflating this bubble is not going to work as the air comes out of it. And the air is going to come out of it, despite whatever efforts the Fed may pursue to prevent that. I think they've already pricked this bubble, and there's really no way to prevent it from deflating. I think the inflation that we've experienced in 2021, a lot of that was largely the delayed consequence of the inflation that was produced prior to 2020. I don't even think we've caught up to that inflation yet, which is one of the reasons that we're going much higher. Not only wasn't inflation transitory, but it's going to be far higher than it was during that supposed transitory period. And of course, I was one of the few people, in fact, at the Money Show in earlier presentations, when the Federal Reserve was claiming that the inflation we were experiencing would be transitory. At the time, I said the Fed was lying about that. I said that inflation was as transitory as the subprime market was contained. That's exactly the lie that the Fed told us in 2007 when the mortgage market blew up, the subprime market. The Fed told us not to worry, that there wasn't going to be a problem, that the damage was contained to this small segment of the mortgage market. It wouldn't affect the overall housing market. It wouldn't affect the economy. And of course, we ended up with the 2008 financial crisis. I think in many respects, people at the Fed might not have even believed those lies, but they told them anyway because they wanted to placate the markets. They didn't want the markets to be afraid of what was going to happen. And I think that was pretty much what they were doing again this time. They didn't want to level with the markets and deliver the bad news about how bad inflation was going to be. So they just pretended it was transitory. Now, maybe they also hope that the problem will go away. In fact, they're still hoping it's going to go away, because if you look at what Powell is talking about doing in order to fight this inflation that it now admits wasn't transitory, is too little too late. What is the Fed proposing? Well, in March, they may raise interest rates from 0, where they remain, to 0.25%. And then maybe by the end of this year, they will have raised interest rates up to 1% at the end of this year. And then maybe at the end of next year, they will raise interest rates to 2%. Now, how are you going to do something about an inflation problem by throwing gasoline on it? Because a 1% interest rate, even if we get there at the end of the year, is still a stimulative rate of interest. In fact, 1% is the rate that Alan Greenspan slashed interest rates to in 2002 when he wanted to stimulate the economy following the September 11th attacks and the collapse of the NASDAQ bubble. That was considered a very stimulative monetary policy. Yet somehow now it's an aggressive tightening that's going to take care of the worst inflation in 40 years. And the reality is, it's not the worst inflation in 40 years. It's the worst inflation ever. Because 40 years ago, when we were measuring inflation, we were using a very different CPI than the one we're using now. So you can't really compare the CPI today to the CPI 40 years ago when they're completely different. So if you measured what happened to prices last year with what happened 40 years ago using the same CPI that was being used then, in 2021, we had an increase in consumer prices of about 15%. And that would make it higher than any year of the 1970s. In fact, it would be higher than 1980, which until last year was the high watermark for the CPI at 13.5%. But how did we put out the inflation fire in 1980? Well, Paul Volcker brought interest rates all the way up to 20%, so that we had a real rate of interest of 6.5%, and we created a powerful incentive to hold on to US dollars and to save money, because we offered savers a very high real yield on their savings. And of course, Treasury bond yields also soared. I think the yields on 30-year bonds got up to something like 14%. And so we were offering a positive yield. Well, even if the Fed follows through with their commitment to raise rates to 1% by the end of the year, Inflation, even if you believe the government's numbers, which I don't, at 7%, 1% is still a negative 6% interest rate. You are not going to encourage savings with negative 6%. You're not going to discourage debt. You're not going to do anything to change the dynamic. You're not going to get out in front of the inflation curve. You're going to fall further and further behind if you continue to stimulate with cheap money. So first of all, to discuss the topic of inflation, the first part of the stagflation equation, clearly we have a huge inflation problem, and we've had this inflation problem for over a decade. It's just that it hasn't manifested itself in a way that was problematic to the Fed or to investors, because the inflation was resulting in asset prices going up rather than consumer prices. I mean, consumer prices went up, but not by an amount that caused an alarm, especially since the government was able to disguise the true degree to which prices were rising with the CPI, which doesn't really do a good job, I think, by design, of accurately reflecting what's happening in prices. It substantially understates the degree to which prices are going up. And so given the ability of the government to pretend that we had inflation below 2%, that gave the Fed cover to continue to create more inflation under the guise of quantitative easing and stimulus and 0% interest rates. But that money flowed primarily into financial assets, but it also fueled a record increase in U.S. trade deficit. In fact, this morning, we got news that the December trade deficit was a new record, $101 billion. That is the first month where we've had a trade deficit in excess of $100 billion. This is merchandise trade, goods. And for the entire year, our trade deficit in goods eclipsed $1 trillion. That is an unheard of deficit. Never before has anything that bad been achieved, by any nation. And so part of that actually kept a lid on inflation, even though the way the government measures inflation, we had a 7% increase in consumer prices. Imagine how much more consumer prices would have gone up had $1 trillion worth of stuff not been dumped into our market by our trading partners. And how did we pay for all this stuff? We didn't. We printed money, and we exchanged the money we printed for the goods that that the rest of the world produced. And Americans didn't even earn a lot of the money that they spent. It was just handed to them by the government in the form of stimulus checks or other bailout money. And where did that come from? Well, it came from the Fed's printing press. We did the worst possible combination of monetary and fiscal policy.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information, and it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar, and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.